biztech's personal finance show. Today's show will be on Retirement Planning 101. What are the basics you need to start financial planning for retirement? I'm Brian Fernandez, your host.
And I'm Sharon Chang, the co-host. Today, our guest is Felix, Neoh, Director of Finwealth Management. Felix, welcome to the show.
Hi, Sharon, Brian. Thanks for having me.
Okay, Felix, the hot issue right now is everyone is talking about Malaysians don't have enough savings for retirement. So can you maybe share with us what should we do and when should we start saving for retirement?
Retirement is always a very hot topic, with the background that we have this year with the pandemic, people's incomes are affected. Everybody is always trying to see how can I access the funds that I have. And, when they look around, EPF or retirement savings comes top of the mind, right? So the question then is, can you really afford to draw down on your retirement savings today, right? And still have a fairly decent retirement lifestyle in the future, right? So I think the question that you raise is, when is the right time to start saving? I think the answer is really, right from the day you get your first paycheck, right? It's never too early to start saving. And why is that the case? Is simply because, right, you want to take advantage of compounding interest. So I'm sure most of us would know and have heard of, what Albert Einstein said about compound interest, right? It is the eighth wonder of the world, right? So he goes on to say, right? He goes on to say, he who understands it earns it, right? He who does not pays it, right? So we really need to be mindful about that. That time is on our side. We really want to use the time that we have, right, to compound the returns of our retirement savings in order to ensure that we have as much retirement savings as possible when the time comes.
Felix, there was a, sorry, Brian.
Go ahead.
Okay, there was a survey that actually reported that millennials nowadays do not even save. So, because they think that their income cannot justify the cost of living. So what can you tell them?
I think it is a fact in many ways that our income levels, especially for fresh grads, has not quite kept pace with inflation, right? And the cost of the living expenses, especially in the larger cities, right? So that is one disadvantage that most millennials already start off with, right? But the truth of the matter is this, right? That we need to take charge of our own personal finance, right? We cannot just say that, I'm going to live for today simply because there is nothing that I can actually save, because at the end of the day, it's still going to come back to you, right? So just imagine this kind of a situation. If you intend, right, to save R1 million, right, by the age of 60, right, when you retire, and if you can get a return of investment, right, of 8% per annum. Now, if you started at age 20, all you need to do is save 285 ringgit a month, right? Now, let's say if you don't start at age 20, if you start at age 30 instead, right, for the next 30 years until age 60, you need to put aside 667. Now, if you procrastinate for another 10 years and only start at 40 years old, it's going to cost you 1,006 to be able to save until you hit the 1 million mark, right? At 50 years, it's going to be 5,004. So you can already see it's very clear. Millennials, I would say, yes, it's challenging. However, whatever you can scrimp, right? If you can cut down on the latte, on the expenses, that you can actually look at cutting down on, if you're able to do that, the little bit that you can save will actually give you very good returns because you have time on your side.
So Felix, I want to take that what both of you said in terms of what Sharon said, that millennials are not saving enough, and then the 285 or 88 ringgit that you mentioned that you need to save as a 20-year-old. Now technology has helped us in the saving process. Now, obviously, you said you have to start early on, and I was going to ask you, one question is, how do you start saving? And one way that technology has helped is companies like Stashaway, which basically then help you a little bit, or puts a little bit aside every month. But what other methods could we use perhaps to help us in terms of forced savings? I think you mentioned lattes there. Now, are there tips for us to start savings, and what sort of methods? How would we put that away?
Okay, so the first thing that you should actually do is, right, settle on one or two of the different types of so-called investment platforms, right? You could choose the robo-advisors that you mentioned just now, right? Or you could choose other type of so-called DIY investment platforms, right? There are quite a number out there today, right? Now, whichever that you choose, just go along with it, right? But most important is to automate that savings, right? So that you don't have to always ask, should I be saving this month? Hey, how's the market? Huh? Oh, the market's down. Okay, yes, I want to do the savings this month. And next month, when you ask the same question again, hey, the market has gone up. Oh, no, I think I will not go in this month because the market's up. So you don't want to have that kind of conversation with yourself every month, right? To decide whether or not you want to do the savings or investments, or you don't want to. So automating that savings is very important.
Felix, just say for high income earners, okay, higher income earners, should they actually have a certain percentage of their income set aside, or should they actually have a fixed amount?
Okay. I think, you know, at the end of the day, what typically happens is that as our income rises, so does our lifestyle, right? So imagine if you are stuck in, you know, the savings amount that you have actually started when you were 25 years old, and then as your salary rises, you are still stuck in the savings that you were, you know, when you were at 25 years old earning, you know, 30,000 ringgit, then it's not going to be able to support your so-called future lifestyle, right? Because your lifestyle has actually gone through, you know, lifestyle inflation, if you like. So the way we normally position it to our clients is, you definitely need to start somewhere. You should immediately aim for the 20 to 30% of your gross income, right? Now, I'm sure many of your audience would have also heard about the movement among the younger crowd, this thing called
The
FIRE,
FIRE movement.
right?
Yeah.
Exactly, right? So financial independence, retire early. Now, for those who want to go down that path, the 30% savings is not going to get you there. You're still going to end up with a traditional retirement age, right? So for those people who aspire to FIRE, so to speak, you need to aim to the 50% mark, the 60% mark, right? Or, you know, or more. So that is, you know, the kind of target that you should aspire to save, right? Now, of course, the other question that one might ask is, hey, am I ending up oversaving, right? And as a result of oversaving, I'm not living for the today, right? I'm not living it now, right? I might not be able to enjoy the fruits of my labor in the future, right?
Especially
So,
our instant gratification society.
exactly.
Yes.
Yes, right. Exactly. So I like the way that US TV personality, Susie Orman, if you all have heard of her, the way she puts it is
Yes.
basically very simply, live below your means, but within your needs. So you make sure that all your needs are satisfied, but make sure that it's below your means, right? Simply because you want to make sure that that savings goes on, you know, to be able to ensure that you have a good retirement in the future.
Now, Felix, I want to ask you about target savings. Now, and I want to put that in a context of lifestyle, because target savings for somebody who has a $3,000 a month income and is 50 years old is very different from a target savings of somebody who has 30,000 ringgit per month income and they want to retire and they have a retirement target. Could you give us some rule of thumb in terms of what should we aim for as target savings in order to have a certain lifestyle and when we start spending?
Okay, I think the way that I will approach that question will be a little bit different. What I mean by that is this. When you're saving towards retirement, what you're really trying to do is to ensure that your savings and the investments today, right, is able to so-called supplement the paycheck that you're getting, right? The savings and investment of the future, I should say, is able to supplement the paycheck that you're earning today. So the question is really about what are the expenses that you have, right, today, right, or in the future that you are really trying to compensate from the salary, right? So it's about understanding what is your lifestyle like. What is the cost of that lifestyle? So when you are able to answer that, right? For example, today, what are your expenses like, right? In the future, what do you think the expenses will be? So if you understand your expenses, which is a representation of your kind of a lifestyle, then you would know, right? If I go down this path, if I continue on this path, this is the amount that I would need to save, right? Because I want to continue to, enjoy my lattes and what have you. But let's say, for example, you say, no, I don't want that kind of a lifestyle. It's too materialistic and I'm not willing to work the additional 5 years or 10 years just to support that kind of a lifestyle. I want a more simple lifestyle. Then the amount that you need to save in order to meet your retirement goal will be less, right? So, it is going to be very different for different people, but it really does start from how much do you require to support your kind of a lifestyle.
So, Felix, maybe you can share a bit more on what kind of financial instruments that and assets that actually we can actually use to save for retirement. Maybe you can share with our audiences.
Okay, so I mean, as you can imagine, there will be so many different types of investment vehicles that are available, right, for retirement savings. So the typical one obviously is the EPF, right? And then there is now also the private retirement scheme, right? So that's to supplement your retirement savings. But a lot of people, what they would do is they will also invest in equities, shares. So you can either go for direct share trading or direct share investment, I should say, or if picking up stocks on your own is not your cup of tea, then you can actually default to the fund managers by investing through unit trust funds, for example. Brian mentioned another platform, which is the robo-advisors, right? So low cost using ETF. So that's another excellent example of investment vehicles suitable for retirement. Now, the typical Malaysian will also say, hey, you know what? I aspire to have, buy one house for each child. And then, they can actually either, sell their property in the future to fund the education expenses, or, they can actually live there. So property investments is another popular vehicle, right? But again, in this day and age, there are a lot of alternative assets as well. So, there are crowdfunding type of investments. I think many of your readers would have also been exposed to cryptocurrencies, right? So I would say the list of vehicles available, right, for long-term investments, right, that would be so-called suitable for retirement savings is plenty. But the advice that I would like to give the audience really is this, right? Please make sure that you invest through regulated investments and in regulated markets, right? Because there have been just so many cases of scams that have been going on, right?
Yes, and that's been a big problem in the last few years, hasn't it?
It has been. And you know what? They're always targeting the older generation simply because the older generation have the money, right? And they are always under this impression that, especially this year, interest rates are very low already. I really must find something else as an alternative for FD. So then that's when they start hunting, right, for other alternatives with the mindset that they want a higher so-called return on investment. But very often they forget to ask the most basic question, right? If I want my money back, can I get it back? Is it safe? Is it going to be sound? Is the capital going to be there, right? So it is the return of investment. Can I get my investment back? That many people actually fail to also evaluate.
Now, also one of the things I think Felix, and what I'd like to ask you is, we've talked about instruments and assets, but what should be the asset allocation strategy? So you mentioned quite correctly, traditionally, a lot of Malaysians, probably the T20s in particular, and the middle class as well, have a very high proportion of their assets in basically property, with that whole mantra of, okay, I buy one for a child, and when it's time for university, you sell it, and then I can fund that education. That has worked whether it's a very simple, very unsophisticated strategy. The thing is, it has worked very well in the past, but obviously the world has changed. Returns have changed on property assets. So what do you recommend should be an asset allocation strategy for retirement?
Okay, so I wouldn't say that the retirement strategy will be very different if you are retired, but as an investor, right, you must always have what we call the strategic asset allocation in mind. Now, the strategic asset allocation is going to depend on your risk profile as well as your investment horizon, right? How long you're going to be invested in. So take a very simple example, right, of a moderate risk investor. Now, a moderate risk investor, he wants to grow his wealth, but he is also quite concerned of losing capital should the markets tank. So a typical moderate risk investor would have anywhere between 10 to 20% perhaps of the investable assets in low risk kind of assets, right? Another 10 to 20% in so-called the high risk volatile kind of assets, the ones that can so-called give a little bit of a kicker to the overall performance of the investable assets. But the balance are actually going to be in your typical moderate risk kind of assets. So moderate risk kind of assets would represent balanced type of portfolios, a little bit of equities, a little bit of bonds. So overall, they're quite fairly balanced. Property does feature in that kind of space as well, right? But we normally would suggest anywhere between 30 to 40% of exposure in equities is actually quite sufficient. And you are right, Brian. Many a times you come across Malaysians having way more than that. And the problem is this, right? We have actually encountered customers who've actually purchased properties to fund the kids' education. And in the last 1 to 2 years, when they are about to send the child overseas, for their education, and they're trying to dispose of the property, the issue now is they can't find a buyer. There isn't an offer in sight, right? So forget about negotiation. There's no offer. What negotiation can there be, right? So as a result of that, if you have the right kind of asset allocation in so-called properties, within that moderate rate space, moderate risk space, right? And if you're able to cap it yourself between 30 to 40% in property, right? So if you can't can't dispose the property, you have other assets that you can actually dispose, right? But if property is all you have, then you might be in a bit of a pickle.
And one of the things that, and since you've mentioned that in terms of, and this is a real issue, unable to sell your property to find a kid's education, one of the ways, obviously, in retirement or at a late stage, is then to either do a reverse mortgage or refinance your existing property in order to then fund that education or that retirement. Would you recommend things like that? That will be a way around it, correct?
Yeah, I wouldn't say offhand that would be the recommendation, but that is definitely an option. But we really do need to study because reverse mortgage is something fairly new in Malaysia, right? It has actually been introduced for a very long time overseas. There are the pluses and the minuses, as you can imagine, and the cost is not exactly very cheap if you really work out, the actual the cost of borrowing for that purpose, right? So we really need to study that, right? But those are some options available, right? Another option that's available is study local. Don't go overseas.
Yes, yes.
Right? Because at the end of the day, right? I mean, I've been telling clients, at the end of the day, unless the kid is going to the Ivy Leagues of the world, right? The top universities, otherwise is the top universities or the rest. So it is
And
actually more about the personality of the graduate, right? The type of personality, the kind of a mindset, right, that will actually get you the job is not so much the, which university do you come from and all that kind of thing. So you might have to rethink, right, in terms of the
Felix,
overseas education.
I just did a seminar there on education, and those were actually some of the things that I espoused. And I think we need to have another conversation about it, another show, and we'll bring an education expert, and I'm going to call you back. But I think, Sharon, you've got a question about our retirement time bomb that's happening in Malaysia.
Yeah, because many Malaysians would actually just depend on their EPF contributions, right? But according to the EPF statistics, it shows that 70% of contributors actually who takes out their money at the age of 55 would not have enough to actually retire. It would not even last them 10 years. So what can you say about that, Felix?
Yeah. To be very honest, whenever I hear these statistics, in my simple mind, I'm always wondering, I would like to think that the EPF contributor does have funds outside of EPF to fund the retirement, but I'm not very sure. I never got it answered. Whether or not the statistics obviously is based on retirement savings with EPF, but what about, does that retirement expenses get supplemented with assets outside of EPF? I'm not sure about that.
So
but definitely,
one of the things, Felix, with that, and I've asked that same question before, and one of the answers that I got was the fact that with some people, for example, especially the informal economy, business owners and staff, yes, there are other sources of income, but that is the minority, because I was questioning that as well. That is the minority. A lot of people, retirement money is EPF. Why the funds get exhausted is a lot of times at 55, they withdraw the entire amount, they renovate their house, they buy a car, and then suddenly they realize they don't have enough money to move on, because basically the kids have come and asked them for money. And so I did a little study on this some time ago. This is exactly the statistic over and over again. This is why people run through their retirement money in 5 to 10 years.
Yeah. I can imagine that's going to happen, right? So to Sharon's question, what do we think of that? It's obviously worrisome. And that's the reason why, as a licensed financial planner, what we try to do is that we do try to share with whoever we speak to, right, as well as our customers, that you really do need to put your finances in order, start saving, have that discipline, right? To put that funds aside and, make sure that you have, you don't have lifestyle creep, eating into your ability to save for the long run, because we definitely need much more than 228,000, because 228,000 or whatever that number is, is not going to last us very long at all, right? So that's definitely worrisome.
True. Yeah, it's true. But Felix, what if we are around 40 or even 50, above 50 years old, and we realize that we do not have enough savings, right, for retirement? What should we do?
Okay, I think the first thing that we really need before we can do anything is we need to know where we stand, right? So when you say that you might not have the funds, enough saved and all that, so we really need to have that clarity on our personal financial situation, right? So need to do that spring cleaning, need to do the housekeeping, right? Determine, our assets. What do we really have as our assets? What are our liabilities that will go on, right? What is our income? What's our expenses? We need to determine our net worth position, right? So basically assets less the liabilities. What is the net worth, right? And what about the cash flow? Are we in so-called having negative cash flow on a monthly basis, or are we able to eke out a surplus, right? Then the question is, what about expenses, right? Because if you don't have enough saved, let's say if the realization is that you don't have enough saved, then we need to really ask ourselves, okay, so of the income that we are earning, what are we spending money on, right? And what kind of retirement expenses do we think that we would be incurring, right? So ultimately, that should bring about this question on what is the retirement number? So what is your ideal retirement number? Is it the 1 million? Is it the 2 million, right? Whatever that number is, then we need to follow up with, okay, so if that is what I need, what do I have today? What is the shortfall? Or is there a surplus? Maybe you're pleasantly surprised, when you finally, take out all your listing of the assets that you might have, right? Perhaps there's going to be a surplus. Now, in the event, right, that no, you are still right, it is a shortfall, then the question becomes, how do we make up for that shortfall, right? Because you don't have that many years left. Your runway is probably going to be another 10 to 20 years, right? If you're stretching it a little bit, right? So the question is, how do we make up for the shortfall? Or another way of putting it, how do we still grow our net worth, right? Or grow our net worth more effectively, right, over the next couple of years? So number one, I would say, is that you have to increase your income. You've got to look for ways to increase your income, right? Or your savings, right? How does that happen? Basically is, perhaps, you should be taking on some additional kind of job, right? Or consider extending your working years. Maybe you should not be retiring at 55 as you originally planned. Maybe you should be working until 60, right? And looking to reduce your current as well as your future expenses. So that is one, right? Increasing your savings, right? Number two, we need to increase our investment return, right? The ROI, right? What you are,
That's a tough
what you,
one, Felix. In
yeah,
this low interest rate
Yes.
regime, I think one of
correct.
the things that we all traditionally we think about when you talk about retirement is rule of 4%, and you live on 4% of your assets. In today's kind of low interest rate regime, our whole modeling has to, and the mindset has to shift a little bit. We have to live with lower returns potentially.
Correct. So now the question becomes, does it mean that all your retirement savings has to be in that low yielding kind of assets? Or can some of the retirement savings be put to better use with the potential of generating that higher returns that will then enable a higher overall return on your investable assets, right? So the choice of investments is very important, right? Now, there are many people who are very scared, right? They might have experienced investment loss and all that kind of thing. So what they might end up doing is that they might put everything in very safe assets. Now, the problem with very safe assets is that it would take you a very long time to grow your money, right? So if you have heard of the rule of 72, right? If you take 72 divided by the number, the return that you're getting, that's going to be the number of years it would take for you to double up your money, right? Have you heard of this rule, 72?
Yes.
Yes. So now the thing is this: if you're going to get a 4% return, let me pull out my phone. 4%, 72 divided by 4%, right? Is actually going to take you something like 18 years to
Yes.
double your money, right? So that's a very
Yeah.
long time. But if you're able to get, double that return, right? Then it will take you half the time to grow your money. So you must still look for ways to get a better return on investment. However, as I mentioned earlier, be careful of scams, right? Very, very disconcerting, right? The third thing that you must focus on is also to try and reduce the financial risk that you're exposed to. Because if you don't reduce the financial risk, then what's going to happen is that your assets that you've actually built up for retirement will get used for
Eroded,
all those
Yeah.
kind of eroded because of all those expenses that might come your way, right? So one very simple example is, for example, insurance coverage, right? If you don't have medical coverage, for example, and you're no longer working in a company that offers very good medical benefits, then you have to pay for the medical costs. So that is a risk in that sense. And the last thing that you need to focus on in order to grow your net worth is basically to reduce financial costs, right? So we talk about people who have got either whatever kind of investment. Sometimes when you go through unit trust investments, and if you don't pay attention to the costs, you might be paying 4.5% to 5% sales charge, right? So that's very expensive. In actual fact, you should not be paying more than 1 or 2% at the very most, right? What about insurance, right? If you go for wrong type of policies, they might be quite expensive, right? So I'm sure your readers and you would have heard of this term called buy term and save, invest the rest, right? So that's trying to reduce the cost of insurance. So you need to do all of this for increase your savings, increase your ROI, reduce the financial risk, and reduce the financial cost. If you're able to do this effectively, then you will see you might be able to so-called make up for lost time, right? Because you're already so-called a little bit older already, and you don't have that many years left to save, right? But I think, Brian, I would like to also stress that if you are actually going through the motions, going through this motion at 40, really what you need is you can't muck around anymore, right? You really need to have clarity on your financial situation. You do need to have a comprehensive financial plan, right? So it's either, if you are capable of doing it, you need to chart out your comprehensive financial plan. Otherwise, you do need the assistance of a licensed financial planner to help you to do that.
Now, final question, Felix. How do we move, as we head towards retirement, the spending pattern, the retirement pattern then changes. So we go from basically savers to basically spenders, because we're starting to spend our retirement money. So what are your thoughts on that, and what sort of guidance would you give us?
Yeah, so I think, okay, a typical Asian is quite a fairly good saver, or at least we try to,
Really?
right? Yeah, I would like to think so. I would like to think so, right? We know how to save, right? For many, perhaps many of your readers, they know how to save, right? But the thing is, they do not know how to spend what they have saved, right? They don't know. So you ask a person who has bought shares, right? Especially the so-called new share investors this year, right? Who picked up this so-called, lack of a better word, habit during the MCO, right? Suddenly they're buying shares and all that, but many of them only know when to buy. They do not know when to sell, right? So again, when you are approaching retirement, what happens, right? Now you're no longer going to be a saver. Now you have to start spending what you have already accumulated. When you go to the ATM on the 25th of the month, oops, no, I'm sorry, nobody's going to put any money into your account for your monthly expenses, right? So you need to strategize on how to move from saver to so-called slowly spending your retirement nest egg. So what I find is a good way to think about this is very simply the so-called the 3-bucket strategy. So I'm not sure whether you've heard of this, the bucket strategy, but it's a very simple concept. Obviously, I'm simplifying it, to make it understandable. But the way you think about it is this, right? So imagine 3 buckets where you put your funds, your assets, your investments, and what have you. So the first bucket is really so-called to live for the now, right? So the now being, because again, you're in retirement already, we are talking about the first 3 years of your retirement, right? The immediate 3 years. So that bucket really is money that is not really meant for investments at all. You don't want to take risk on that, right? It is going to be very safe kind of investments. Why? Because it's going to fund your living expenses for the next 2 to 3 years, right? So we are talking about safe kind of investments like fixed deposits, bonds, or your money market type of funds, or capital protected type of products, right? So they are meant, right? Because at the end of the day, you don't want to downgrade your lifestyle just because something happens, especially in the immediate. So that's why you want to keep it safe and sound. That would be the first bucket to cover like the first 3 years of your retirement. The second bucket is really going to be slightly longer term investments. So imagine investments that you can set aside, leave aside there for the next 3 to 7 years, right? So that will take you to 10 years really, right, of your retirement. Now this one is going to be filled with your growth kind of investments, equities, dividend paying stocks, growth funds, property investments, for example, where you can still earn rental income and capital appreciation perhaps and all that. So that is the second bucket, right? To take you for the next 7 years, right? Now, anything beyond that would be what I call the third bucket, right? So the third bucket is going to be investments that you can leave there for the next 10 years, right? Eventually, you might get to selling it. Otherwise, you can still hold on to it, right? So what will happen is that, the type of assets that typically suit those type of, that bucket, the third bucket is, for example, if you have an ongoing business, you might not want to sell it immediately. Sometimes you might feel that, hey, you know what, this is to be passed to the next generation, right? So that is one, a business that you might have, or perhaps your home, right? Perhaps you don't want to so-called sell the home and you want to so-called spend everything else, but leave the home at least for the kids, right? So that is something that's suitable for the third bucket. Now, what you'll find is the second bucket, the income for the second bucket, or the profits from the second bucket can then be used to replenish the first bucket, the first 3 years of your investment. So basically, when you have this, you can just imagine, right? It's like a waterfall, it's cascading, right? So the buckets will fill. The second bucket will fill the first bucket, right? Third bucket fills the second bucket fills the first bucket, so that you will continuously have the income that you require in retirement. So it's a very simple kind of analogy, if you like, but I find that it's quite simple and it's easy to understand and it gets the message home.
Felix, that will end on that very interesting note. Thank you very much for taking your time to be on the show and to share your insights and wisdom. We've been speaking to Felix Neoh, the director at Finwealth Management, on biztech's personal finance show on retirement. I'm Brian Fernandez.
And I'm Sharon Chang. This video will be on our Facebook and LinkedIn site, as well as our website, www.biztech.asia. Please check out our website for business and technology conversations on articles, videos, and podcasts, and subscribe and like our Facebook and LinkedIn pages. Thank you so much, Felix.